6 months, has done a bunch of US tours, has done a bunch of global client conversations, and he would have thoughts of his own about what to do with the Nifty at 25,000. Nirav, great having you as always. Thanks for taking the time out. We are no longer at 22, but geopolitical tensions behind us, trade tensions behind us. Is this a conducive environment to invest, or would you believe we need a bit of a valuation reset?
No, so I've believed for some time, Niraj, that the decks are stacked up for India. We had a bit of wobbly situation. It was a bit of nervous situation because, wars are very easy to start, very difficult to pull back. The history goes against you. So, but we are back on track. I feel very bullish. And, I've had this view for some time that the biggest advantage that India has got right now is that there's a big dollar reset that is happening, right? Very rarely would you have a situation where, the equity markets in US have rallied and, bonds have gone up and the dollar is depreciated 10% from the top, right? So this is a big reset. And there's a very conducive environment for emerging markets in general and India in particular. So short answer to your question is that very bullish. No one knows what happens in the next 1 or 2 months. But I would wager that in the next 5, 6, 7 years, India will end up being the bubble market in the emerging market territory.
Hi, good morning, Tamanna here. At the best of times and at the worst of times, there's one point that I have to make, that Nirav Sheth is always very bullish on India. So this is the one time where actually I think the whole atmosphere and wave is with you as well because of
Tamanna,
that's what the entire mood is.
Right.
Yeah.
Let me come in. So I sort of agree. And I try and keep on pinching myself that, I'm a perpetual bull. But I like to go by data. So you look at the last 5 years, 10 years, 15 years, 20 years. There is only one period where US market has outperformed the Indian markets in dollar terms. You are the best performing dollar return markets in the 5, 10 and 20-year bracket. That tells you something, right? So you do well. And why should you be even bearish when you got this kind of returns in the past 20 years? And the future is looking better than what it has been in the past.
No, completely. And on facts. It's not just, chest beating. It's on facts and money has been made. Now, the question is that if there are opportunities right now, are we seeing in this consolidation phase in the market right now an opportunity to set yourself up for the next phase of the bull rally? Because we've seen a period of turbulence, I would say 5, 6 months, and then some pullback as well. But we're evenly placed below the 25,000 mark right now. What would a Nirav Sheth do at this point?
So, I'll tell you what, when I talk about being bullish on the market, you have to look at, what are my alternate avenues, right? So I would want to have a 20% return. Maybe I want to double in the next 3 years. But where do I go and invest, right? So returns are always relative. So I look at my options in terms of what I'm going to get in the bond market, what I'm going to get in the real estate market, what I'm probably going to get in the commodity, what I'm getting in the equity markets. In that context, I don't see a clear line of sight of being invested in anything other than equity. That is number one. Secondly, the way I look at it is that it is important that we have the right policies to try and ensure that my economy continues to hum around at about 6.5%, 7%, which with my earnings will grow at about 12 or 13%. And if that is the case, then you should ideally expect that the markets could double in sometime around 5 years or something in about 6 years. Broader markets, which means that within that, some sectors that will do well, some sectors that will not do well. But yeah, most important thing, I think the big reset that has happened to me, I think for the first time now you got monetary policy that is aligned to your economic reality, right? You need stimulation. Your credit growth has been stagnating. When I talk about credit growth being stagnating, for the last 10 years, my credit to GDP ratio has been flat, right? So we are running an unusually tight monetary policy, maybe because of inflation or whatever it is. I'm not a great believer in that, but I'm no economist. Going forward, I suspect that your rate cuts will be deeper than what the markets are believing in because you are getting more outcome focused. You need to drive to a particular objective, there is nothing called 100 basis points of real interest rates or 200 basis points of real interest rates. I think that we are done with the fiscal tightening. So monetary policy is in favor, fiscal policy is in favor, and therefore, ideally, the fact of the matter is that this should start reflecting in earnings growth rate.
Nirav, okay, yes. Let's say you pinched yourself and you still found that it's worthwhile to be bullish. Now, when I look at, for example, earnings, not just for Q4, but maybe Q3 and Q4 and the commentary that has come in, right? There are select pockets that are sounding very constructive and select which are sounding slightly skittish. And I was trying to get your view on maybe 2 or 3 of those. Your guys have written a very good note today, for example, on a Blue Jet Healthcare, the management that we are going to speak in the next 5 minutes after you. And that prompts me to my first question. Across the board, except for a Piramal Health, CDMO companies have done really well. Now, Pharma is in a bit of an eye of a storm, if you will, but CDMO is shining bright. What do you think of healthcare and pharmaceuticals currently?
That calls for some level of domain expertise. So I will not get into too much of detail. But from what I understand, and from my, I've got a very good pharma analyst, we are not very constructive on companies that have got an exposure to US trade market, by and large. So we are not a great believer of a rebound in profitability of US generics. Companies that are logically facing the Indian markets, which is more of a consumer sort of a play, are the companies that we generally tend to like. But you also have to appreciate that these are the kind of companies that are going to grow at about 6, 7, 8% growth in free cash flows, very similar to like how the consumer companies are growing. And therefore, your ability to make any superior alpha or generate superior alpha out of that could be probably limited. Those are not my sector focus. I'm trying to predict what could be the next big delta. Can you identify the next Eternal? Can you identify the next tech stories? Are there any great outliers in the infrastructure? Are there any great outliers in the EMS space? Niraj, what is happening, right? For the last 20 years, we've never been a part of this global supply chain, right? And now when I look at the next 20 years, a lot of the companies are going to fall in that space, right? So those are the things that you want to look at. Now, valuations could be out of the story. Sometimes the stories are out of the valuations. To me, those are my focus areas because that is where the big delta, in terms of both earnings delta, in terms of valuation delta, could be there.
What are you liking right now? Are you seeing maybe a return of the broader and small caps, mid companies right now? Because for the last few months, we've just been hearing stick to the tried and tested, look at the large caps. Do you see that now reversing as confidence grows?
Well, I have a slightly different view. So I think people are getting anchored by what has happened in the last 4 or 5 years, which is like, your small cap index is up some, I think, 4 or 5 times. But you try and push that timeline into last 8 or 10 years, then it probably compensates for a serious underperformance pre-pandemic, right? So earnings to a large extent are mean reverting. I, for one, and I'm now talking more anecdotal, more bottoms up, I think there are far better growth opportunities in a large tail that India has created, right? And there are more companies getting listed. Actually, curiously, if you look at the construct of the large cap companies, and I'm now talking about the Nifty companies, and then if you look at the earnings evolution over the next 2 or 3 years, you're not getting many strong, even double-digit growth rate. I mean, just pick up the private sector banks, right? And we also like that space. But look at the consensus earnings growth rate for, an ICICI or Axis or a Kotak. If I'm not mistaken, that number is close to about 8 or 9%. Maybe the analysts are behind the curve, that is my estimate. But the broad consensus estimates for earnings growth rate is nothing to get very excited about. While as you go down the market cap order, there is a significant amount of delta that is happening over there.
Okay. Well, we'll talk about the lower down the order conversation the next time, Nirav, but unfortunately I have to wrap up today. But thank you so much for the insights in today's show. Really appreciate your time.
Pleasure. Thank you, Niraj. Take care. Bye.
Take a break. On the other side, VK